Hey guys, Matt here. Welcome to another portfolio update. I gotta say, we're still looking pretty good. And I mean, earlier today, just look at my Instagram. I was up 4 figures, which is pretty good for my portfolio after the 2022 I had. I was doing pretty well until I think last week when the Fed crashed the party by saying what they said about interest rates. But I mean, even then, the measly $247 in the green, I'll take it. And before I go into the changes I'm thinking about making in my portfolio, these stocks here that are in the red. Eventually, my strategy for them is that eventually the Fed is going to stop for these rate hikes, whether it be this year, whether it be next year. Hopefully, they stop it next year. But once it does, institutions are going to start flooding back into these, we'll call them value stocks. And once it does, we will see some profits. In the meantime, we got these tech stocks here, big tech, which is back well into the green. Meta is, it's past 70%. I will sell Meta in October, which is when my shares go long. If you take a look here, most of my shares go long at the end of October. And as long as the price stays roughly the same or better, I'll probably sell out of Meta and then rotate the profits into something that pays dividends. Now, as far as the changes I'm planning on making, now I'm not selling anything, not just yet. I check, Tapestry's well into the green, but checking the PE ratio, it's still well below 15. I thought about Qualcomm, it's still well below 15. So it's still undervalued. I'm not really selling anything. The closest stock that I even thought about selling was Walgreens. I could use the tax write-off. And that's just because, if you've been following Walgreens, it's been involved in legal trouble, and it had to cut its forecast and all that stuff. It is not something good you want to see. The good news is that it hasn't cut its dividend in like 90 years. It's been raising it for 90 years. So I'm happy to take the money. It's just that, I don't know, if I find something better, I could take the tax write-off and then pour this into a stock that I think will do better. But as far as what I'm thinking of buying, Gevo, I'm pretty good with Gevo for a while until it actually releases news talking about their closing net zero one, because I'm supposed to be buying this stock heavily, but I gotta wait for that news because, Gevo being Gevo and all that. But the two stocks I'm planning on buying, I'm considering buying, are very exciting ones: Target or Walmart. Now, I'm not going to insult anyone's intelligence by explaining who these companies are. If you live in America, or even if you don't live in America, you know what Target and Walmart are. Now, I know some of you guys suggested I look into NNDM and other stocks like that, but just to be clear, I am looking at it as far as interesting topics for a video, but I don't buy companies that aren't profitable anymore. I don't do that. Gevo was the last one. I only look at companies that are actually making cash flow, which, for the most part is Target, but let's get into that. Now, I'm just going to go over some of these real quick. It's got a pretty good dividend yield. The PE ratio for Target is still a little high because we still want to, value is still a thing. So I would need to see this price drop into the 120s or better yet, the 110s before I consider buying Target. But everything else looks pretty good. You scroll down here. It's got a payout ratio of 70%, which is not terrible, not great, but also not terrible. It has a pretty healthy history of raising its dividend over the past 5 years. And then the analyst estimates, which is, we can't take as gospel, but it's fun to look at. It shows a pretty substantial EPS gain, which for a dividend stock is pretty good. And then the EPS estimates, now they do show Target as shrinking over the next 5 years after next year, but we'll see how that goes. Now, the only thing that gives me pause is their free cash flow, which is in the negative. Now, the operating cash flow is pretty good. If you go here, they have a pretty substantial net income, down a lot from the previous years, which is a bit concerning, which, that's another thing to worry about. But, their capital expenditures is pretty high, which is the negative cash flow. And even if you go on the quarterly cash flow, as far as the latest quarter, it's still negative. And then 2 quarters before that, it's also negative. So that is something that I would have to look into before I actually commit to Target. But it is an interesting stock to look at. Walmart's another company I was looking at, but their dividend yield isn't, well, it's not great compared to Target. I mean, statistics speaking, it has a high 4 PE, which is, the price would have to come down a lot before I considered buying Walmart. The PE ratio is a lot healthier, though. Or not payout. Now, I know you can't see this, but it's 54%, which is much better than 70%. One thing that Walmart has that Target doesn't have is a positive cash flow as of this year. And if you take a look at the quarterly estimate, it continues to have a positive free cash flow. Not much, but it's staying in the positives. Now, I'm probably going to look harder into Target than Walmart, given that Target is closer to a good PE and it has a better dividend yield. I just have to look into the negative free cash flow and make sense of that and see if it's still worth investing. But I'm going to look into both companies. Let me know in the comments if you were invested in either one of these companies, which one you like more. And yeah, take care, have a great day, and eat your vegetables.